Good evening, everyone. Time for this week's silver update. This is the current chart of silver. We're at 34.20 roughly, and you can see on our trend line we broke below. I was expecting a dramatic fall as we broke below this line, and we didn't get it, so we're waiting to see what the resolution of this is going to be. Now, I'll remind you about the length of the MACD that we had, the last major correction we had. And that's roughly 1, 2, 3, 4 months that the MACD stayed below the zero line. So we're now on 1, 2, and we're entering into the third month. So if we follow a similar pattern, for us to get back to the zero line, which was a very long time relative to historical data, this was the longest period it took to get back to the zero line. We've got about a month or two to go for us to cross over and begin to rally. So that would be kind of coincidental that would happen about the end of August, or in September would be a near correspondence to what we had here. So we're waiting to see if we rise from here, and it's probably a good time to buy because there's a good chance we won't get to this level. I was looking for the next support level, which is around 31.5. And that was where I was expecting us to go if we corrected and broke down through this trend line. And you can see just a little blip on the MACD that we look to be turning up, so we very well could turn up from here and actually come across the zero line in a 3-month time frame, which is a little bit tighter than this last one. But if you remember, this coincided with the economic collapse of the United States and most world governments, so it wouldn't be surprising to see this come and cross the zero line in a shorter amount of time than this happened. So we're going to watch that and see. Again, I want to emphasize it's a good time to buy. I'm not going to go over the recommendations I have for the coins to buy right now, but I did want to review some of the coins that I purchased in the past. And if you remember, I purchased, the last major purchase I made was at 25 right here, and I purchased the Lunar Tigers at that point. Now, if you remember, I told you that the spot price was 25 and I purchased the Lunar Tigers at 30. So let's jump over to eBay and see where we're trading. I've tightened the search as much as I can, but you're going to get some strange ones in here. This isn't from a Perth mint. I don't know what this is. And this Lunar here is actually Series 1. The ones I purchased were Series 2, and they weren't colorized. Kind of interesting, you can see that the colorized one went for $163. And I don't know what this one is either. But this is a coin that I bought. This is the 2010 Australian Lunar Tiger 1 ounce Lunar Series 2. And you can see it sold for $84 July 3rd. We've got another one here that sold for $66. Oh, here's another one for $74.58. 66, 62, 61, that one didn't sell, 58, 52, 55, and down it goes to about, looks like the best deal was back in June. Someone got one for a little over $50. So obviously the premium on this coin is expanding dramatically. That's what I expected when I bought it, and that's what I expect when I recommend numismatic coins that are created by the government mints that have unique patterns and are collectibles because they're so rare. So I've always recommended playing silver in this way because a number of reasons. Primarily, it insulates you from the market shocks of these type of manipulations, and this was just a manipulation. The price, I fully expect the price to exceed this price and then probably run to $60 or $70. I'm not sure what the time frame is, probably next fall, but the point is now is the time to keep stacking, and I'm going to show you why when I examine the physical market. Now, I want to address a controversy that's going on right now in regards to the Jeffrey Christian article about the 100 to 1 paper to physical ratio that was admitted in the CFTC hearings. And recently SGT Bull has had Eric Sprott and a number of people on his show talking about that ratio, Bix Weir, and there's been some people disputing that, and it's causing a little bit of controversy. So I really wanted to examine in depth the paper to physical ratio in silver, and I spent some time trying to research the Comex numbers, but frankly, I don't think the Comex is that important. First of all, if you remember, I mentioned in a number of past videos how the Comex, and this is actually admitted on FOFOA's silver article blog, that the Comex actually only amounts to 5% of the physical silver that's delivered in a year. And he admitted in that blog that the Perth Mint accounts for 15%. So actually, when you talk about physical silver delivered to industrial users or investors in a year, the Perth Mint actually delivers 3 times the amount that the Comex does. So the Comex is doing about 5%, and we'll just do a rough calculation and just say it's $1 billion, but it's not even that number, but it's in the high 800 or 900 million. So we'll just say $1 billion, and if it's $1 billion times 0.05, then really the Comex is only delivering about 50 million ounces a year physical. There's really only 50 million ounces of silver that are taken off that exchange in physical delivery. So that's a tiny amount compared to the amount of physical silver that is mined in a year and that is used by industrial users. So I'm going to start off by saying that it's kind of stupid to talk about the Comex open interest and prices because the Comex doesn't really do that much silver, honestly. So the numbers I wanted to look at that I think are a lot more important are the numbers that are produced by the BIS. Now, for those of you that aren't familiar with it, the BIS is the Bank of International Settlements, and it's located in Switzerland. And it is the bank, it is the central banker's central bank. So this is the bank that sets the rules and regulations for other central banks to follow, such as capital requirements and things like that. It also tracks statistics of open interest and derivative swap numbers, etc. So I wanted to examine some numbers in the latest. Now this has through December 2010, so it doesn't have 2011 statistics, but this is the latest information from the BIS, and this is something that Jason Hommel has been referring to in his articles. So I wanted to examine this, and the 3 categories we're going to look at are derivatives for equity contracts, and then we're going to look at derivatives for gold, and then we're going to look at derivatives for other precious metals, which is a byword for silver. I'm going to explain to you why that's the case, but this category really is silver. So what I want to do is examine the percentage of derivatives compared to the value of the outstanding stock. So I'll show you how that works here with total equity contracts. With total equity contracts, we have, as of December 2010, and you have to look, these numbers are denominated in billions of US dollars. So for total equity contracts up to December 2010, we have $5.6 trillion, because that's 5,635 billion. So we've got 5.6 trillion in total equity contracts. Now if we go down to gold, we have 396 billion in contracts, in derivatives based on gold. And silver, which is in the category of other precious metals. Now the other two are palladium and platinum. They're basically negligible because they're such tiny markets and the amount mined is so tiny that it has no impact. But just for purposes of calculating the numbers, I took 23 off of there and just said that 100 is silver. So we're going to use 100 as silver. So to make these comparisons, we need these numbers, which are the derivative values based on the outstanding contracts, and then we need to know the underlying values of the markets that these derivatives are based on. So let's go and look at, we'll start off with stocks. So if you want to look at the market cap of all stocks, they give you some numbers here on Wikipedia. The total market capitalization of all publicly traded companies in the world was 51.2 trillion in January 2007. Now you know we had a pretty strong crash, went to 57 trillion, then it fell below 50 trillion, then went to 40 trillion, then we know we've rallied. So I'm just going to use a rough number of 50 trillion. So I'm going to say that the outstanding market capitalization of all equities is 50 trillion. Now, the other number we want is the outstanding market cap of all gold. And that's debatable, of course. The one I decided to use was based on this article. And this is an older article, so we've got to add some numbers to it. But the question here is how much gold in the entire world, all the gold in the entire world, how much space would that take up? And it's kind of interesting because he points out here that if you looked at all the gold mined in a year, it's about a 14 by 14 by 14 cube. And that would actually fit in your living room. But we want to look at all of the gold that's ever been mined. Now, you're not going to get a agreed upon number here, but I'm just going to go with this number because this number is actually quoted in a lot of places, and we're looking at about 10 billion ounces. Now, some may quibble with the fact that I'm using this as the deliverable amount, but there's a reason I'm using this, and that's because most of the gold is actually deliverable. That's because the price is so high that most of the gold is actually stored in bullion bars in central bank vaults. So yes, you have some gold in jewelry and you have some gold in India, and yes, it's probably lower, but I'm just going to go with this number because I think that 90-something% of the gold that is out there is actually in deliverable form, as far as either being Comex deliverable bars or easily converted to Comex deliverable bars. So we're going to use this number of 10 billion ounces. Now, the harder number for us to get is going to be the number for silver. And as you know, if you've been following my channel, silver is a wholly different animal than these other assets because they have been demonetizing it for the last 100 years. So there is no stockpile, the bullion banks don't have any, and we're just down to the point now where we're dealing with what is mined every year and what is deliverable. Now I think the amount listed by Stella Concepts was 130 million on the Comex. I'm not really sure what that is if you look at the LME. We know that roughly 1 billion ounces are mined every year, and roughly 100 to 200 are taken by investors, and then the other 800 or so is used up by industry, and because the price is so low, it is unrecoverable. So I'm just going to use the figure of 1 billion ounces. That may be right, it may be low, it may be high, I'm not really sure because the numbers are hard to find, but we'll just use that number. So what I did was I created a spreadsheet based on these numbers. So if you take the value of all the equities in the world and you take the value of the derivatives based on those equities, based on the BIS's numbers, then the derivatives based on equities are 11% of the outstanding value of all the equities, which seems pretty reasonable because you want to have the base market be the key market and then the derivatives follow that. Now, if we go down to gold, we have roughly $15 trillion worth of gold in the world. That is 10 billion ounces valued at $1,500 an ounce. Now, the derivatives based on the BIS report are $396 billion worth of derivatives that are written on that underlying asset of $15 trillion worth of physical gold. And that amounts to only about 3%. Now let's look at silver. We went with $34 billion as the value because we assumed that there's 1 billion ounces of deliverable silver available to be delivered right now. I think that number is super high, but we'll still go with that just in case. Now that BIS report gave the number of 123. We know that silver is the largest amount of that other precious metals category because palladium and platinum are so tiny, so we gave it 100 billion. Now when we do those figures, we find out that 300% is the amount of the value of the derivatives that are written off the underlying. So that's the number that you have. Now, some have said, well, that's not 19 times or that's not 50 times. But what's important about it is I think these numbers are low for silver. I think they're much worse than this. But even with this being the case, if the derivatives written off of the existing deliverable silver are higher than the silver available, you can see this market is way out of whack. And if we put this market into whack with, say, the way gold is, so if silver became remonetized because the people decided that it's money and they wanted to remonetize it, and it forced the physical and the derivatives to come back into some kind of normal line or semblance of reality, then if that happened and it became the same valuation as gold, you would see a 100-fold move in silver, physical silver, to bring it back into line with the derivatives price that is based on it to be in alignment with gold. That would be a 100-fold move. So that would require a price of $3,400 an ounce. That's what it would take for silver to be equally valued as gold on the basis of derivatives based on it. Now, if we wanted to go to a price that would bring it in line with all stocks, then that would be a 30-fold move. So silver would have to go to roughly $1,000 an ounce to have the derivatives based on it be equal as a percentage as the derivatives that are based on all the stocks in the world. So These numbers from the BIS show you that silver is way out of alignment with other financial assets. And it's not surprising because silver is being manipulated. Now, the reason why this is important, the reason why that 100 to 1 or 19 to 1 or whatever figure you want to use is important is because if you have a market where the vast majority of the price setting determinations are made by buys and sells that are paper, they're not the underlying. And we haven't talked about SLV, we haven't talked about, we're going to assume those were included in the BIS numbers, but we don't know. But if you have a market where the vast majority of price discovery is based on derivatives, then what that means is that what determines the price is the pockets of money. So let's imagine a market. Imagine a market where, let's say, for every one contract that was deliverable of the physical, there were, say, 1,000 or 10,000 or 100,000. Let's just say it's 0. So take the SLV for example. Let's say that the SLV has no silver whatsoever. Let's say the SLV decided, hey, we're not going to back this with any physical silver. We'll just make a market where we determine the price based on taking delivery of futures and trading futures back and forth. And we're not going to store any silver in any vaults anywhere. We're just going to base our price on that. So imagine you had a market like that. What would determine the price? Well, obviously, if there's no physical backing to the market, then the only determinant of price is going to be the amount of dollars held by the longs and the amount of dollars held by the shorts. So, obviously, if we begin to approach that number, which is what silver is doing, whether it's 1% or 1/10 of 1% or 5%, we know that it's way out of line with all other markets. So if the vast majority of price discovery is being done by money and not by the commodity, then we know that it's easy to manipulate this price, and this price isn't a real price. So we already know, we've proven in a number of articles, that silver is the most highly manipulated commodity. Ted Butler has proven that the short concentration in this market is greater than any other market in the history of the world. 40% of the short positions are controlled by 4 banks, and these banks happen to be banks that have unlimited money. So we know by the example we used that as the percentage of real commodity decreases to the point where it's infinitesimal, then obviously the only determiner of price is going to be the amount of money that you have. And if the people who are shorting your market have an unlimited amount of money, whether it's JP Morgan or HSBC or Goldman Sachs or the Federal Reserve, if the people who are shorting the commodity that you're trading in, which is trading at a tiny percentage of physical, if the shorts have all the money in the world, then the shorts can set the price wherever they want. And that's exactly what Bixwer has said, and that's what SGT is saying, and that's what Eric Sprott is saying, and that's what Stella Concepts is arguing against, and he's dead wrong. It is a market that is totally disconnected from the physical price, and the Comex only delivers 5% of the silver that's mined in a year to the actual users. So it's a market that is disconnected in multiple ways from reality. It's being manipulated by people who print money and have unlimited amounts of printed money and have a vested interest in suppressing this reported price. And that's why the price is so low. And we'll talk to you next time.